Hi guys, so our topic for today is the chapter 8, which is the money markets and capital markets. When we say money markets, the term money markets refers to the network of corporations, financial institutions, investors, and governments which deal with the flow of short-term capital. So when a business needs cash for a couple of months till a big payment arrives, or when a bank wants to invest money that depositors may withdraw at any moment, or when the government tries to meet its payroll in the face of the big seasonal fluctuations in tax receipts, the short-term liquidity transactions occur in the money market. So the money markets have expanded significantly in recent years as a result general outflow of money from the banking industry. So a process referred to as disintermediation. Until the start of the 1980s, financial markets in almost all countries were centered on commercial banks. Savers and investors kept most of their assets on deposit with banks, either as short-term demand deposits such as check writing accounts, paying little or no interest, or in the form of certificates of deposits that tied up the money for years, drawing on this reliable supply, the low-cost money, were the main source of the credit for both business and consumers. So how it works? So money market exists to provide the loans that financial institutions and governments need to carry out their day-to-day operations. For instance, like bank may sometimes need to borrow in short term to fulfill their obligations to their customers, and they use the money market to do so. For example, most deposit accounts have relatively short notice period and allow customers access to their money either immediately or within a few days or weeks. Who uses the money market? So the primary function of money market is for banks and other investors with liquid assets to gain a return on their cash or loans. They provide borrowers such as other banks, brokerages, and hedge funds with quick access to short-term funding. The money market is dominated by professional investors, although retail investors with 50,000 can also invest. Smaller deposits can be invested via money market funds. Banks and companies use the financial instruments traded on the money market for different reasons and carry different risks. So here in the example, there is a companies, banks, and investors who actually uses money markets. What money markets do? So there is no precise definition of the money markets, but the phrase is usually applied to buying and selling of debt instruments maturing in 1 year or less. The money markets are thus related to bond markets, in which corporations and government borrow and lend based on long-term contracts. Similar to bond investors, money market investors are extending credit without taking any ownership in the borrowing entity or any control over management. Yet, money markets and the bond markets serve different purposes. Bond issuers typically raise money to finance investments that will generate profits, or in the case of government issuers, public benefits for many years into the future. Issuers of money markets instruments are usually more concerned with cash management or with the financing their portfolios of financial assets. Now, let's move on to the types of money markets instruments. So, money market securities are short-term instruments with an original maturity of less than 1 year. So there are numerous types of money market instruments. The best known are commercial papers, bankers' acceptances, treasury bills, repurchase agreements, government agency notes, local government notes, interbank loans, time deposits, bankers' acceptance, and papers issued by international organization. So the amount issued in the course of a year is much greater than the amount outstanding at any one time. As many market securities are outstanding for only short period times. So money markets securities are usually more widely traded than longer term securities and so tend to be more liquid. So first, let's move on to the commercial paper, which is one of the money market instruments. So commercial paper is a short-term debt obligation of private sector firm or a government-sponsored corporation. So only companies with good credit ratings issue commercial paper because investors are reluctant to bring the debt of financially compromised companies. So they tend to be issued by highly rated banks and are traded in similar way to securities. In most cases, the paper has lifetime or maturity greater than 90 days but less than 9 months. So this maturity is dictated by regulations. In the Philippines, most new securities must be registered with the regulator, which is the Securities and Exchange Commissions. So commercial paper is usually unsecured, although a particular commercial paper issue may be secured by a specific asset of the issuer or may be guaranteed by bank. Now let's move on to bankers' acceptances. So before the 1980s, bankers' acceptances were the main way for firms to raise short-term funds in the money markets. An acceptance is a promissory note issued by a non-financial firm to a bank in return for a loan. So the banks resell the note in the money market at a discount and guarantees payment. Acceptances usually have a maturity of less than 6 months. Bankers' acceptances differs from commercial paper in significant ways. They are usually tied to the sale or storage of specific goods, such as an export order for which the proceeds will be received in 2 or 3 months. They are not issued at all financial industry firms. They do not bear interest. Instead, an investor purchases the acceptance at a discount from face value and then redeems it for face value at maturity. Investors rely on the strength of the guarantor bank rather than of the issuing company for their security. Next, let's move on to treasury bills. Treasury bills, often referred to as T-bills, are securities with a maturity of 1 year or less, issued by national governments. Treasury bills issued by a government in its own currency are generally considered the safest of all possible investments in that currency. Such securities account for a larger share of money market trading than any other type of instrument. So that's all on my part.
Government agency notes. These are debt securities issued by government-sponsored enterprise or GSEs. They are backed by mortgages and offer a relatively safe investment option, but they're not as risk-free as treasury securities. Next is local government notes. These are notes issued by municipalities, countries, and other local government entities to finance projects like infrastructure and improvements. They are often considered relatively safe, but their um, credit worthiness depends on the specific local government's financial health. Next is interbank loans. These are loans between a banks often used for short-term liquidity needs or to meet reserve requirements. They are typically unsecured and have very short maturities. Next is time deposits. These are deposits held at the bank for a fixed period of time, earning a fixed interest rates. They are least liquid than demand deposits, but offer higher interest rates. And lastly is repos or republic agreements. These are short-term loan where one party sell a security, usually a government bonds, with an agreement to repurchase it at a later date for a slightly higher price. Repos are common tool for banks to manage their liquidity and interest rate raise. Next, I'm gonna discuss capital market. So, capital market is a financial market in which long-term debts or original maturity of 1 year or greater and equity instruments are traded. Capital market securities include bonds, stocks, and mortgages. Capital market securities are often held by financial intermediaries such as insurance companies and pension funds, which have little uncertainty about the amount of the funds they will have available in the future. So, capital market participants, the primary issuers of capital market securities are the national and local government, and second is the corporation. The national government issues long-term notes and bonds to fund the national debts, while the local government issues a note and bonds to finance capital projects. So, however, corporation issues both bonds and stock to finance capital investment expenditures and fund other investment opportunities. Next is capital market trading. So, capital market trading occurs in either the primary market or the secondary market. So, the primary market is where new issues of stocks and bonds are introduced. Investment funds, corporation, and individual investors can all purchase securities offered in the primary market. A secondary market, on the other hand, is where the sale of previously issued securities takes place. And it is important because most investors plan to sell long-term bonds before they reach maturity and eventually to sell their holdings of the stock as well. So there are two types of exchange in the secondary market for capital securities. First is organized exchange and over the counter exchange. Whereas most money market transactions originate over the phone, mostly capital market transactions measured by volume occurred in organized exchange. Other arrangements can be as follows. First is competitive sale. The investment bank can purchase the bonds through competitive bidding against other investment banks or by directly negotiating with the issuers. Second is negotiated sale. With a negotiated sale, single investment bank obtains the exclusive rights to originate, underwrite, and distribute the new bonds through a one-on-one negotiation process. With a negotiated sale, the investment bank provides the origination and advising services to the issuers. Third is best efforts underwriting basis. In their arrangement, the underwriter does not guarantee a firm price to the issuer. The investment bank incurred no risk of mispriced pricing the security issued since it simply seeks to sell the securities at the best market price it can get for the issuing firm. The advantages and disadvantages of using bonds can be summarized as follows. First, let us know what are the advantages. First is long-term debts is generally less expensive than other forms of financing because first is investors view debt as a relatively safe investment alternative and demand a lower rate return. And second is interest expenses are tax deductible. Second advantages is bondholders do not participate in extraordinary profits. The payment are limited to interest. Third advantage is bondholders do not have voting rights. Fourth is flotation costs of bonds are generally lower than those of ordinary or common equity shares. So here there are three advantages on the other hand. First is that other than income bonds result in interest payment that if not met it forced the firm into bankruptcy. Second disadvantages is that other than income bonds produces fixed charges, increasing the firm's financial leverage. Although this may not be a disadvantage to all firms, it can certainly is for some firm with unstable earnings streams. Third disadvantages is that must be repaid at the maturity and thus at some point involves a major cash outflows. Fourth disadvantage, the typically restrictive nature of indenture covenants may limit the firm's future financial flexibility. As of September 2019, the following are bonds issuance by the government, business firms in the Philippines, secured by bond funds and part of the investment portfolio mutual funds. ALFM Peso bonds, Gapalite bonds, Philam bonds, Philiquity Peso bonds, Sun Life Prosperity bonds, RCBC Sustainability bonds, Robinson bonds, fixed rate corporate bonds, PH Samurai bonds, and Ayala Land Incorporated Philippine bonds.
Let us now discuss about bond features and prices. So bonds are a form of investment wherein investor lends money to a company or government in exchange for regular interest repayment and the return of the original amount or what we call as par value at maturity. So understanding the bond features and how they are priced is very crucial for both the investors and the financial managers. So first is the par value. This is the face value of a bond, which is the amount repaid to the bondholder when the bond matures. So the purpose for this is to determine the principal repayment amount and serves as the basis for interest payment. Like for example, if you purchase a bond with a par value of 1,000 pesos, the issuer promises to pay you back 1,000 at the end of the bond term. Now next is number 2, coupon interest rate. So this is the fixed percentage of the par value that the bondholder receives as interest income annually. The formula for this is annual interest payment divided by the par value. Like for example, a 10% coupon bond with a 1,000 par value will pay a total of 100 pesos. So 10% times 1,000 is equals to 100 pesos. Interest payment per year. So why it matters though? So the coupon rate determines the interest income from the bond. However, if market interest rates rise, the bond's price may drop since newer bonds may offer higher tax rates. Now, the third one is maturity. This is the length of time until the bond issuer repays the par value to the bondholder. So there are types of bonds by maturity. First is short-term bonds, which is less than 3 years. Medium-term bonds, 3 to 10 years. While long-term bonds is more than 10 years. So like for example, a 10-year bond issued in 2025 will mature in 2035, which is 10 years from now. And then fourth one is indenture. It is a legal agreement between the bond issuer and bondholders detailing the terms and conditions of the bond. Now there are the 4 key components: bond description, which are the coupon rate, maturity, and par value; rights of bondholders, these are the payment schedule, priority in case of bankruptcy. Next is obligations of the issuer. It must be paid interest and the principal on time. Last is the rule of the trustee. This is a financial institution ensuring the issuer follows the agreement. Now, fifth one is current yield. It is a measure of a bond's return based on its market price rather than the par value. Like this is the formula is current yield is equal to annual interest payment divided by market price of the bond instead of the par value. Like for example, you have a 1,000 bond that pays 100 pesos annual interest but trades at 900 pesos in the market. So you need to divide the 100 pesos annual interest to 900 pesos in the market, which equivalent to 11.11%. Now, if a bond's market price falls, its current yield rises, making it more attractive to new investors. Now, number 6 is yield to maturity. This is the total return an investor will earn if the bond is held until maturity, including all interest payments and price in appreciation. The formula for this is approximate YTM is equal to annual interest payment plus the par value minus current price divided by years to maturity, and then divide it all to 0.6 times current price plus 0.4 times par value. It's a bit complex, but you will just read it to the book or refer it to the book na lang. So for example, like you have a 1,000 bond with a 10% coupon rate, trades at 900 pesos and has 10 years to maturity. So using the formula, you just need to substitute the given numbers. So YTM helps investors compare bonds with different prices and maturities. Now let's move on to the credit quality risk. So by definition, the risk that the bond issuer fails to pay interest or principal on time. So who will assess this risk? Credit rating agencies like Moody's, Standard & Poor's or S&P, and Fitch analyze financial conditions and assign rating. So there are 4 factors that improve bond rating. First is low debt levels or low financial leverage. Second is strong and stable profits. Third is large company size or less risk of default. Last is limited use of subordinated debt. Now let's move on to understanding credit ratings and below investment grade bonds. So credit ratings are evaluations of a bond issuer's ability to repay its debt, provided by major rating agencies such as those following who will assess the risk. These agencies analyze a company's financial health, stability, and past credit history before assigning a rating. So, bonds rated to from AAA to BBB are considered investment grade, meaning they are issued by financially strong entities with a low risk of default. Investors buying these bonds can expect steady interest payments with minimal concerns about losing their money. So here is the breakdown or its interpretation. So AAA means highest quality. These are the safest bonds issued by highly stable governments or corporations with excellent financial health. The chance of default is nearly zero. So next is AA, which means high quality. Still very safe but slightly more exposed to economic downturns than AAA bonds. Next is A, which means upper medium grade. The issuer is financially strong, but external factors like economic recessions could slightly affect its ability to pay. Now last is BBB, which means medium grade. So bonds at this level are still investment grade, but they carry moderate risk. If economic conditions worsen, these issuers may struggle to meet their debt obligations. So now, I will now break down the below investment grade bonds. First is BB, which means somewhat speculative. The issuer has financial challenges, but there's still a reasonable chance they will meet their obligation. Now next is B, means speculative. These bonds are more vulnerable to economic downturns, and payments might be delayed if the company faces financial trouble. Next is CCC, which means highly speculative. The company is in serious financial distress and highly likely to default unless it finds additional funding. Now next is CC, which means most speculative. The company is on the verge of collapse, and investors may not get their money back. Next is C, which means imminent default. The issuer is already experiencing severe financial difficulties, and default is almost certain. Now last is D, which means default. The issuer has completely failed to make interest or principal payments, meaning bondholders may lose most of or all of their investment. So overall, the bonds provide fixed income but can fluctuate in value. And understanding bond pricing, yields, and risk is essential for both the investors and the financial managers. And then credit ratings help the investors assess risk versus the reward. And money markets are for short-term investments, while capital markets are for long-term growth. And that would be all with my part. Thank you.
Hey everyone, my name is Jean Rose Liagas. So today I will be reporting the types of bond. So first, the unsecured long-term bonds. Under this is the debentures, subordinate debentures, and income bonds. So the debentures are unsecured long-term debts and backed only by reputation and financial stability of the corporation. So because of the bonds are unsecured, the earning ability of the issuing corporation is the great concern to the bondholder. So, to provide some protection to the bondholder, the issuing firm may be prohibited from issuing future secured long-term debts that would create additional encumbrance of asset to the issuing firm. The debentures will allow it to incur indebtedness and still preserve some future borrowing power. The subordinated debentures, claims of bondholders of subordinate debentures are honored only the claims of secured debt and unsubordinated debentures have been satisfied. So, the income bonds An income bonds requires interest payments only if earned and non-payments of interest does not lead to bankruptcy. So usually issued during the reorganization of a firm's financial difficulties. Generally allowed to accumulate for some period of time and must be paid prior to the payment of any dividends to stockholders. Second is the secured long-term bonds. Under this are the mortgage bond. So the mortgage bond is bond secured by on a real property. So the market value of the real property is greater than the mortgage bonds issued. So under this are first mortgage bond, second mortgage bond, blanket or general mortgage bond, close-ended mortgage bond, open-ended mortgage bond, limited open-ended mortgage bond. So first, let us discuss first mortgage bonds. So, they have a senior claim on secured asset if the same property has been pledged on more than one mortgage bond. The second mortgage bond, claims on assets are paid only after the claims of the first mortgage bond have been satisfied. The general blanket or general mortgage bond, all assets of the firm are used as security to the bond. And then the fourth one, the close-ended mortgage bond, forbids the future users of the pledged asset security for other bonds. This protects the bondholders from their claims on the asset by future mortgage bond. So, the fifth one, open-ended mortgage bond, it allows issuance of additional mortgage bond using the same secured asset as security. However, there is restriction. It may be placed upon borrower requiring that additional asset should be added to the secured property if new debt is issued. So the last one is limited open-ended mortgage bond. So this bond allows the issuance of additional bonds up to a limited amount of time at the same level of priority using the mortgage asset as security. So there are other types of bond. The floating rate or variable rate bonds, junk or low-rated bonds, euro bonds, treasury bonds. So let us discuss what is floating rate or variable rate bonds. So floating rate bonds is one which is the invest payment changes with the market condition. In periods of unstable interest rates, this type of debt offering becomes appealing to issuers and investors. So a common feature of all floating bond rates is that an attempt is being made to counter uncertainty by allowing the interest rate to float. Example, the interest rate may be adjusted quarterly at 3% above the 3-month London Interbank offered rate. In this way, a change in cash flow to the firm may be offset by an adjustment in the interest payment. So the junk or low-rated bonds. The second one, these are the bonds related to BB or below. The major participants of this market are new firms that do not have an established record or performance. Although, in recent years, junk bonds have been increasingly issued to finance corporate buyouts. Since junk bonds are more speculative rates, they carry a coupon rate of between 3 to 5% more than the 3A's grade long-term debt. So the Eurobonds. These are the bonds payable or denominated in the borrower's currency. but sold outside the country of the borrower, usually by international syndicate or investment bankers. Usual country that sold this are Switzerland, Japan, Netherlands, Germany, United States, Britain, and 2 other countries. An example of this might be a bond of USA company payable dollars and sold in London, Paris, Tokyo, or in other countries. The use of Eurobonds by US firms to raise funds has fluctuated dramatically, with relative interest rates and abundance of lack of funds in European markets dictating the degree to which they are used. So the last one, the treasury bond, or carry the full faith and credit backing of the government, and investors consider them among the safest fixed income investment in the world. The BSP sells treasury securities through public auction, usually to finance the government's budget deficit. So when the deficit is large, more bonds comes to auction. In addition, the Bangko Sentral ng Pilipinas uses treasury security to implement monetary policy. So, the ordinary common equity shares. So the ordinary equity shares, traditionally known as ordinary equity shares, is a form of long-term equity that represents ownership interest of the firm. Ordinary equity shareholders are called residual owners because their claims of earnings and assets is what claims after satisfying the prior claims of various creditors and preferred shareholders. So, business firms organized as a corporation may be choose to issue publicly trade stocks, publicly owned corporation, or keep ownership only among the original organizers or the closely held corporation. So as owners, ordinary shareholders are considered to be residual domains. This means that ordinary shareholders have the right to claim any cash flow or value after all other claims have been received that they are owed. These profits can be used maybe to reinvest in the firms to foster growth or to pay out dividends to shareholders or a combination of the two. It depends on the shareholder. So the shareholder assumes a limited liability because their risk of potential loss is limited to their investment in the corporation's equity share. The feature of ordinary equity share. First is the par value or no par value, authorized, issued, and outstanding. Third is no maturity. Fourth is voting rights. Fifth is book value per share and the numerous rights of stockholder. So let us discuss par value or no par value. So this is ordinary equity share may be sold with or without par value. Whether or not ordinary equity shares have any par value is stated in the corporation's character. Par value of ordinary equity shares is stated value attached to a single share at issuance. Additional paid-in capital, paid capital surplus, or capital in excess of par. A firm issuing no par share may either sign a stated value of place in it on the books at the price at which the equity share is sold. So second, the authorized shares. The maximum numbers of shares in a corporation may be issued, amending its character. The meaning of issued shares is the number of authorized shares that have been sold. So the outstanding share means those shares that held in public. Previously issued shares that are required and held in the firms are called treasury shares. Thus, outstanding shares is issued share plus treasury share. Third is no maturity. So, ordinary equity shares has no maturity and is permanent form of long-term financing. Although ordinary shares is neither capable nor convertible, the firm can repurchase its shares in the secondary market either through brokerage firm. A tender offer means a formal offer of purchase shares of a corporation. Fourth is voting rights. Each share of ordinary equity generally entitles the holder to vote on the selections of the BODs or the directors and in other matters. Shareholders unable to attend the annual meeting to vote may vote via proxy. So proxy means the transfer of right to vote to another party. So the proxy voting is done under the rules and regulations of the SEC, which means the Security and Exchange Commission. But proxy solicitations are firms' responsibility. And not all ordinary equity shareholders have equal voting powers. Some firms have more than one class of shares, which are the ordinary or common equity shares. Typically has limited no voting rights, while the Class B has full voting rights. So let us discuss the majority voting, the two common systems of voting, which are the majority voting and the cumulative voting. So the majority voting is a voting system that entitles each shareholder to cast one vote for each share owned. Majority voting is used to indicate the ordinary equity shareholders' approval or disapproval of most proposed managerial action on which shareholders may vote. So 50% of the vote, it can elect all of the directors and prevent minority shareholders from electing any directors. While the cumulative voting is a voting system that permits the shareholders to cast multiple votes for a single director. So cumulative voting assists minority shareholders in electing at least one director. Cumulative voting in some jurisdiction for electing the BOD. So the fifth is the book value per share. The accounting value of an ordinary equity share is equal to the ordinary share equity, which means the ordinary share plus paid in capital plus the retained earnings divided by the number of shares outstanding. The last one, the numerous rights stockholders. So, collective and individual rights of ordinary equity shareholders includes among the right to vote on specific issues as prescribed by the corporate charters, such as selection of the BOD, selecting of the firm's independent auditor, amending the articles of the incorporation and bylaws, increasing the amount of amortized stocks, and so forth. So, this would be all of my report. Thank you.
Today, I will be discussing preferred shares, their key features, and their significance in financial markets. First is the par value. Preferred shares have a par value, which is the face value stated in the stock certificate. This amount is used as basis for calculating dividends. Unlike common shares, which may not have a par value, preferred shares often rely on this value to determine payments to shareholders. Second is the dividends. One of the main advantages of preferred shares is the dividend payments. These dividends are usually fixed and paid before common shareholders receive any earnings. However, they are not always guaranteed, as companies may decide to skip dividend payments under financial difficulties. Third is the cumulative and non-cumulative dividends. Preferred shares can either be cumulative or non-cumulative. If the dividends are cumulative, any missed payments will be carried forward and must be paid before common shareholders receive dividends. On the other hand, non-cumulative dividends do not accumulate, meaning if a company does not declare dividends in a given period, the shareholder loses that entitlement. Fourth is the no definite maturity date. Unlike bonds that have a fixed maturity date, preferred shares are usually designed to be permanent equity in a company. However, some preferred shares have retirement provisions, such as a call feature that allows the company to repurchase the shares after a certain period, usually at a premium. Others may have a sinking fund provision, which requires the company to set aside funds to buy back shares over time. And then fifth is the convertible preferred shares. Some preferred shares come with a convertible feature, meaning shareholders have the option to exchange their preferred shares for common shares under specified conditions. This is beneficial for investors who want the security of preferred shares but also the potential for higher returns from common shares. Sixth is the voting rights. Preferred shareholders typically do not have voting rights, unlike common shareholders who can vote on company decisions. However, if the company fails to pay dividends for an extended period, preferred shareholders may gain limited voting rights as a protective measure. 7 is the participating features. Certain preferred shares have participating features, which means shareholders can receive additional earnings beyond their fixed dividends. If the company performs well and declares extra profits, participating preferred shareholders can share in these gains along with common shareholders. However, most preferred shares are non-participating, meaning their earnings are limited to the fixed dividend amount. And then 8 is the protective features. Preferred shares often include protective covenants to ensure that dividends are regularly paid. These provisions may limit the amount of dividends the company can distribute to common shareholders or require the company to maintain certain financial conditions before issuing dividends. In the event of bankruptcy, preferred shareholders have priority over common shareholders when claiming assets. 9 is the call provision. A call provision gives the issuing company the right to redeem preferred shares at a specified price after a certain period. This allows the company to repurchase shares when it is financially advantageous, often at a premium price above the par value. And then the last is the maturity. Older preferred shares were often perpetual, meaning they had no maturity date and would remain outstanding indefinitely. However, modern preferred shares may have a sinking fund or maturity date, ensuring they are eventually redeemed. Next, we will discuss the valuation of preferred shares and understand how we determine their intrinsic value. So let us define first what is preferred shares. Preferred shares are a type of equity security that has characteristics of both debt and equity. They have a claim on income and assets before ordinary shares but come after that in terms of priority. This means that preferred shareholders receive dividends before common shareholders, but they are still behind bondholders or creditors in case of liquidation. Preferred shares are similar to common shares because they do not have a fixed maturity, but they also resemble that because they offer fixed dividend payments, just like interest payments on bonds. Now we will go into discuss how preferred shares valuation works. Valuing a preferred share is relatively simple as long as the firm pays fixed dividends every year. If the company continues paying these dividends consistently, they can be treated as a perpetual stream of income. This allows us to calculate the present value of all future dividend payments. Since preferred shares are riskier than bonds, investors usually require a higher rate of return to compensate for the additional risk. This is because in the event of financial trouble, creditors and bondholders are prioritized over preferred shareholders. This is the formula for intrinsic value of preferred shares. The intrinsic value of a preferred shares is calculated using the following formula. the preferred shares equals D sub P divided by P sub P, where D sub P equals the per share cash dividend and P sub P equals the investor's required rate of return on the preferred share. This formula tells us that the value of a preferred share is simply the annual dividend by the required rate of return. Next is the comparative features of the ordinary equity shares, preferred shares, and bonds. So when comparing ordinary equity shares, preferred shares, and bonds, we need to look at several key features. First is the ownership and control. Ordinary shareholders have full ownership rights, including voting power in company decisions and a claim to profits. Preferred shareholders, on the other hand, have limited control and usually do not have voting rights. Bondholders do not own any part of the company. They are just lenders who receive interest payments. Next is the obligation to provide return. Companies are not required to pay dividends to ordinary shareholders, as this depends on profitability. However, preferred shareholders must be paid dividends before ordinary shareholders receive anything. Bondholders have the strongest guarantee, as companies are legally obligated to pay interest on bonds. Next is the claim to asset in bankruptcy. If a company goes bankrupt, ordinary shareholders are the last to receive anything after all debts are paid. Preferred shareholders have a higher claim than ordinary shareholders, but still rank below bondholders. Bondholders and other creditors are prioritized and must be paid first. Next is the cost of distribution. Issuing ordinary share is the most expensive because of legal requirements and regulatory compliance. Preferred shares have a moderate cost as they offer financial benefits to investors but limit control. Bonds have the lowest cost since they are structured as debt instruments with clear repayment terms. Next is the risk-return trade-off ordinary shares. Ordinary shares carry the highest risk because returns depend on company performance, but they also offer the highest potential rewards. Preferred shares have moderate risk since dividends are more stable. Bonds are the safest option as they provide fixed returns but generally lower profitability. Next is the tax status of payment by corporation. Dividends paid on both ordinary and preferred shares are not tax deductible for the company, meaning the company must pay tax on earnings before distributing them. However, bond interest payments are tax deductible, reducing the company's taxable income. Then the next is the tax status of payment received. Dividends received from shares may be subject to tax, but a portion can be exempt if paid to another corporation. Preferred shares follow the same rule. In contrast, interest income from government bonds is often tax exempt, making them attractive to